A presidential debate, an historic commercial spacewalk, and Europe leads the way in rate cuts. This is Bloomberg Wall Street Week. I'm David Weston. This week, Deborah Lehr of Basilinna on what's gone wrong with China. Ruchir Sharma of Rockefeller International on what's gone wrong with housing prices in the United States. And Michael Wolff of Activate on what the explosion in online gambling means for the media world. We start with the upcoming election and what that means potentially for global Wall Street. And we're delighted to have with us Blair Effron. He is co-founder of Centerview Partners. Blair, great to have you back with us on Wall Street Week. We had a debate this week, which gave us some sort of a peek into the economic plans of Kamala Harris, the vice president on one hand, the former president, Donald Trump on the other. What did we learn from it?
So we learned a few things. We learned who Kamala Harris was on a broad basis. Those who know her well and those who know her well in the business community know who she is. They expected her to do what she did last night, which was to be presidential, authoritative, approachable, well-rounded on the issues, and disciplined. And I think it played as a big contrast, obviously, to former President Trump talking about dogs and the like. But most importantly, I got an email immediately last night from a Fortune, we call S&P 100 CEO, who had met her but was on the fence. And he said, boy, this is really dispositive to me. She knows how to lead.
So let's talk about the plan specifically. I mean, atmospheres really count in an election, as we know, but also it counts what these people plan to do. You're in a particular position to understand what the vice president might plan to do in economic policy. You work with her and her team fairly regularly. Give us a sense of exactly how she would address the middle class, because that's the way she started the debate. I really care about the middle class. What is she proposing that would actually make a difference for the middle class?
One, anybody under 400,000 or less will actually see lower taxes. Two, if you're looking for a new home, you'll get a $25,000 credit, and state and local communities will have incentives to build more quickly, cut through red tape, and make it more affordable. Three, she looks at the middle class and says it's not enough for health care to have insulin go down to $35. You need lower health care costs more generally. And very importantly, David, you start thinking about what she wants to do on the innovation economy. How do you help middle class families do well? You support them in building businesses. The idea that she wants to see 25 million new applications during 4 years as presidency is a big deal. And she's raised the deductibility to $50,000 in terms of expenses. She's making it so that if you have an idea, if you have an opportunity, she wants to help you. And most importantly also, or as importantly, she's looking at skills-based jobs, not just college-based jobs. And she wants to see a lot of private-public partnership do that. And then in terms of the middle class, again, she's done nearly $1 trillion of public-private partnerships across the country. And that money is spent in communities, whether it's CHIPS up in Syracuse, New York, Arizona, Ohio. Those are all creating great jobs for the middle class.
There's no such thing as a free lunch. As you go through those programs, there are price tags, substantial price tags attached to each and every one of them. How is she going to pay for it if she can get them done?
So she is incredibly focused on fiscal discipline, but she's doing it in a way that is everybody pays their fair share, but not necessarily punitively. So the highest tax bracket goes to 39.6%. We've been there before. Cap gains, 28%. We've been there before. Ronald Reagan was at 28%. Billionaire tax. What she's telling you is she will figure out responsibly how billionaires pay their fair share. And I say responsibly, you have to pay attention to what she says about her plans versus what she doesn't say. And there's a lot in the Biden-Harris platform, like unrealized gains, that doesn't mean that's where the candidate is. She's going to look at everything and say, how can we raise that kind of revenue? She looks at buybacks. Right now, stock buybacks are 1%. There has been zero difference in impact on buybacks. In fact, 2023 was the largest amount of buybacks by companies ever. That goes from 1% to 4%. So she's highly focused on it. And she looks at the Trump plan and she says that's upwards between $4 trillion to $5 trillion of increased debt on top of the $8 trillion of debt that was created during his first term. So she's very focused on the pay-fors, very.
So the people who would be paying more money are a lot of those people who are emailing you after the debate. They are in that top tax bracket. They're running companies that will be affected. Why should Wall Street support Kamala Harris, given her emphasis on the middle class and taking the money from some of the more wealthy.
Okay, so let's put to bed something that people simply don't understand. The markets have done better under Democratic presidencies over the past 50 years than Republican presidencies. The third year of the Biden administration, which means no COVID impact, versus the third year of the Trump administration, which means no COVID impact, higher GDP, more jobs, better market performance. The CEO, he or she wants stability, wants a free market-based economy, does not want to be sitting here with 10 and 20% tariffs across the board, which is upwards of 1% hit to GDP, 700,000 jobs. They want support from the public sector in a way that helps their business. If they know with certainty what the environment's going to look like, it helps them. And I also do think the signaling matters. When the VP talks about business, she talks about small business, which has been a big focus of hers for a long time. She talks about the entrepreneurial business, the startup community, and she talks about big business, that we're all in here together, aligned to figure out how to grow the economy for broad-based growth, again, back to the middle class. And I think most CEOs understand that.
Let's go to the other side, that is the Donald Trump. I'm not going to ask you to defend his position, but in fairness...
That would be hard.
Well, but in fairness to him, he says one of the ways he's going to address that deficit and that debt is with tariffs. And put aside the fact that that really comes from consumers and is in fact a form of taxation. Why is that not a way to actually retire some debt and deficit? Now, it is a tax. You know, he doesn't call it a tax, but it is on the U.S. consumer. But it is a way of retiring debt and deficit. Why is that wrong?
Because quite simply, if you have tariffs, you're hitting GDP. His 10% hits GDP, perhaps, as several economists have said, 1% hit. If he does 20, because it's been saying between 10 and 20, it's a 2% hit. At 1%, jobs, $750,000 jobs at risk. At 2%, 1.5 million jobs. That obviously has a big hampering effect on the economy. In addition, the tax to consumer is real. And if you think about 20%, he's almost at $1 trillion of tax to the consumer. That does not go, David, to defending the deficit. The deficit needs money coming into the system. That's the deficit. It's not money hurting the pocket of the consumer.
One way that we cover this election is by talking about a so-called Trump trade. We try to take a look at certain equities, certain prices and movement. Even after the debate, there was talk about whether the Trump trade has come off a little bit. Is that a myth? Is there a group of assets, equities or otherwise, that would do relatively better under a President Trump, second President Trump, or do relatively better under President Harris? Great
question. I actually think that most securities trade on so many different factors and so many micro and macro factors, David, that the idea that either president could have an outsized impact, I don't see it. I see that in any presidency, companies will either grow or not grow. They've grown very well during the Biden presidency. There's been a good economy, but they've grown well in other different presidencies as well. So I think it's much more about short-term impact when you talk about the president trade. And when people think long-term, they'll see the markets have done well, depending on the year, with Democrats, and obviously it's done well with Republicans, depending on the year. I think what's more important, around, other than the trade, is to say, what will a company think about in terms of the investments it wants to make, whether it's a 1-year, 5-year, 10-year investment or beyond, based on what they see from one president versus the other. It's the investment, and the investment in the country and the investment in people's businesses that you want to encourage. And I'd be much more focused on that than what the short-term trading aspect is of any particular asset.
Blair Effron of Centerview Partners will continue with us as we turn to his business, the business of deals. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week on Bloomberg. I'm David Weston. We are joined once again by Blair Effron, co-founder of Centerview Partners. So, Blair, take us through your business, at least the way I think your business, the business of deals. When you've been on before, you've predicted that actually this year we would start to see those deals come back after a sort of a quiescent period. Are we seeing it?
So it has come back a bit, and not just deals, but financings as well. But it is by no means where it will be, I think, in 25. There's still been a lot of uncertainty for my world in terms of the interest rate environment, in terms of the election and what that would lead to. Things always, the last quarter, the last 6 months before an election, always people settle down and want to see what's going to happen. Momentum in the economy and regulatory aspects. So it has been a market where companies are still highly focused on M&A, but I would say more highly focused, David, on M&A that is more tactical rather than large, 10 billion, 20 billion above, transformational. I think what you need for that, which I do believe will be coming, is one, interest rates to come down. Remember, the last 4 cycles we've had interest rate declines. After the first interest rate cut, growth has been on average 3% GDP. The markets on average have been up 20%. It becomes a tailwind. It is less relevant whether rates come down over 18 months, 150 basis points versus 100. It's the trend, and it encourages investment from companies, whether it's in their own business, making 10-year bets, or buying a business. And if they believe that they're in the right part of the curve, they are more willing to make strategic 10-year bets in their investment. So I think you'll see a lot of that. I think you'll also see a lot of pent-up demand for financings. And I would expect that the markets, both on equity and debt, but particularly on equity, would open up quite a bit. That gives companies currency, and that matters. Then finally, I think you see a balance between price expectations between a buyer and a seller, much more in line now than they were perhaps in the beginning of 2024.
Take us through that interest rate analysis, because I'm not sure that we always fully understand. There's a lot of debate, even just for next week, is it down by 25 or by 50 basis points, but more debate about where does the Fed end up, with some people thinking it'll end up higher than what the markets think right now, that it's not going to be able to bring it down as much. How important is that in making decisions about making deals, whether we end up at 4.25 or 3.5, for example?
Great question. I think it is so much less important than people ascribe to it. The CEO doesn't look at his or her balance sheet and says, wow, if I can finance at 3.5% versus 3.75%, I'll do the transaction. You're making a long-term strategic decision. Therefore, what you're trying to do is say, what will long-term the impact of the economy, the impact of the rate environment mean to me? And when you see the curve decline, it increases confidence, increases optimism, and that's the difference. I'm always struck by how people are focused on what will happen over the next 3 months in determining how they want to make trades. I understand for certain traders, great, but for my world, where you're talking about businesses, talking about companies, they just don't have that mindset. They're looking at the overall economic picture generally, of which the rate environment is one part of it.
If there is a pent-up demand for deals that's sort of being held off for both when the Fed starts really cutting and where it's going and for the elections, where do you see particular demand that is pent up? I mean, where are there transformational areas? I mean, certainly we cover media a lot, for example. There's a lot in tech. Where do you see sectors that particularly might be ripe for deals? So
I think actually most sectors. There's been in most of these sectors, David, a couple of big deals already. So talk about media. Paramount, obviously a big deal. It's a sector that is entirely under disruption. You should assume we will see more. Consumer, you already saw a big deal, Kellanova Mars. I assume that will lead other companies to think about what they want to do. Tech, in there you have finally, I think, a calibration and equalization between buyer expectations and seller expectations. You'll see more there. Healthcare has been busy throughout. No reason to think it won't continue to be busy. So I would actually argue it's not going to be, from my perspective, just 1 or 2 sectors. I think there'll be a general lifting of the market. And to me, that means a good market in our world now is 5 trillion or above, but a perfectly fine market is 3.5 trillion to 4 trillion. It's hard to imagine that we don't have at least a perfectly fine market in 2025.
Has the deal area been held back a bit by private equity actually retrenching? There's a lot of talk about private equity. What's happened because of interest rate hikes? We've seen some institutional investors actually recalibrate how much they put into private equity. Is that less of a factor for you than it was a year, 5 years ago?
Absolutely. I think the private equity community is 35–40% of the overall market in a good year. I'd be surprised if in 2025 you don't see that part of the market being very active, very robust.
And are corporations stepping into that to do their own deals, not through
corporations are already. You're seeing a lot of corporate activity already, and I don't in any way think that's going to slow down. Remember, the market Ps are down 2.5 points from the peak a couple of years ago, and earnings are still pretty good. S&P 500 earnings for this year and for the next quarter will, again, 80% of the companies will outperform estimates. CEOs feel this kind of tailwind. And my bet is that they will invest against it.
You mentioned regulatory issues, uncertainty over regulatory issues. We are back to the election then when it comes to regulation. We're pretty clear, I think the markets believe, that Donald Trump, if he is reelected, will really pull back on some of the antitrust competition enforcement. Do we have a sense on the other side? Do we think that it's likely to be easier than it was under Biden no matter which way it goes?
So again, if you actually look at the facts, and that's what I'm supposed to do in my job, under the Biden administration and under the Trump administration, the regulatory for antitrust has been the same. In both administrations, 2% of all deals got a second request. And in both administrations, 8 or 9 transactions were challenged in the courts. Okay? I think under a Harris administration, you will see continued focus on competition, on fairness, on consumer impact. That's what you're going to get. But that does not in any way mean you can't put together a transaction that is pro-growth, pro-consumer, and able to pass muster, therefore, with the regulators.
One last question, Blair. I'm curious. If you look back over, I'll say, 5 years, what's the biggest change in your business?
The biggest change in my business is the ease of information and processing information, which has led to even more importance on judgment. What do you do with the information? But boy, we're getting a lot of it, and I'm still trying to figure out what to do with myself.
Blair, it's always great to have you on Wall Street Week. Thank you so much. That's Blair Effron of Centerview Partners. Coming up, football ratings are up, and so is online betting on the games. Are the two related? We ask Michael Wolff of Activate. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The NFL season is now underway, which means a whole new season of sports betting, at least for some fans. To take us through this explosion and what it means for the media of sports, we welcome back now Michael Wolff. He's Activate founder and CEO. Michael, always great to have you. Great. Let's talk about this sports betting. Boy, it is everywhere.
I mean, if you look at overall in the U.S., this year we're going to have about $140 billion in legalized sports betting. That we forecast that within 3 years this is going to be at $200 billion. But here's where the prize is. There's $500 billion of sports betting in the U.S. that is not legal. So what we're about to see is the transition from illicit to legal. And so it's like going from your bookie to BetMGM and DraftKings. and so that's what's going to explode. Now, the numbers for the NFL, $23 billion last year in sports betting, $35 billion this year, but almost 26% of that is one day, the Super Bowl.
Wow, that's amazing. So there's a lot of upside, at least for somebody, maybe not for the bookies, but upside for somebody. Besides the DraftKings and the MGM Sports, who else benefits from this? For example, the leagues.
Well, the leagues, the NFL has made about $1 billion worth of deals with all of the sports betting companies, partnerships. But at the same time, those sports betting companies are spending about the same amount, about $1 billion on advertising across television and digital and other places. And so it's providing a big, big boost to media companies. And part of what's going to change is a lot of what's driven the growth is the number of states that have legalized sports betting. So we're about 39 states so far. There's only a couple that came online last year, Florida, Kentucky, and a couple other places. It's not clear that there's going to be any more. So this is going to be about moving that $500 billion into that core sports betting.
Talk to us about what this means in streaming, because that is the future, obviously, of the media companies that are all trying to get there, trying to be profitable even more than get there. How essential is sports to a streaming strategy?
If we look at the top shows overall on television, they're pretty much all sports, and depending on the time of the year, pretty much all NFL with a couple of things like wrestling in the meantime. But if you look going forward, you can get the NFL on practically over the top outside of television on streaming services. Only a very small percentage of the games are only going to be on television.
So what does that mean, again, for the leagues? Because it's good news for them if they have more bidders. And every time I turn around, there's an Amazon bidding or an Apple bidding.
Well, we're about to see, if you just look at the recent NBA deals where the NBA was able to sell their games pretty much across the board, whether it was Amazon or Disney. We're going to see more of that. These rights become extraordinarily valuable in a world where this is what's getting people to go into these streaming services and getting them to watch television.
So what does this mean for a company like Paramount? We now know, since we last talked, we know for sure what you predicted, which is that Mr. Ellison actually is going to run the place.
Well, it's fascinating. Mr. Ellison is going to run it, but he's bringing in Jeff Shell, who ran NBC, really understands, people don't realize he understands both the studio side of the business and the network side, including the sports and the streaming business through Peacock. So I would expect bringing in a new management team would make a huge difference. To a large extent, this company has really suffered from a lack of investment and a lack of creative leadership.
Are they going to keep it all together, would you expect? Or are we going to have sort of a, if you will, good company, bad company? The streaming and the studio on the one hand, good company, maybe some of the traditional linear media, not so good.
Well, here's the challenge. Most of these media companies still make most of their money on linear. And the studios and the streaming services, for the moment, aren't going to really make a lot of money. But each of these networks and the TV stations and the broadcast networks, they have to learn to manage in a world where there are 50 million cable subscribers. Just a few years ago, we were at 100 million homes in the U.S. Practically every home in the U.S. had some sort of cable or satellite. Now, our firm is forecasting that we're going to go from 70 million homes around now to within 3 years, 50 million homes. They're all going to learn how to manage against that, but still there's a lot of upside through these assets.
Well, a lot fewer basic cable households, a lot more streaming households. I saw a report on Bloomberg actually that said that actually the good news is streaming now makes money. The bad news is Netflix makes more than 100% of the money because the other guys are losing, but Netflix is making up for all the other losses.
You know, if you look back in the history of media, all of the cable networks lost money for their first 5 or 6 years, and then they all started to make money. We're just seeing a lot of competition, and as much as they say they're going to reduce the amount that they're spending on programming, it's a little deceptive because they'll put that programming on their balance sheets. They all have to keep spending. They all have to spend to keep up with Netflix, and they all have to spend to keep up with Amazon Prime. Prime Video is also taking a lot of people's viewing time, especially as they start to add sports.
Thank you so much, Michael. Always a treat to have you here. That is Michael Wolff of Activate. Coming up, the presidential candidates are talking housing prices. But is it a supply problem or a demand problem? We hear from Ruchir Sharma of Rockefeller International. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We welcome back now Ruchir Sharma. He is the chairman of Rockefeller International and author most recently of the book, What Went Wrong with Capitalism. Ruchir, always great to have you on the program.
Thanks, David.
You have a column out in the Financial Times this week about affordable housing, which has become a center point in this presidential campaign, with both sides trying to address sort of the real plight of people trying to buy houses. What's the problem?
Well, I think that if you look at what went wrong with capitalism, the single biggest issue for me is the fact that the average American can't afford to buy a home. And so you have this plight today where more than half of the 20-year-olds in our country are living in with their parents because it's too hard for them to go out and buy their own home. We've had this incredible appreciation in home prices that's happened over the last few decades. In fact, home prices in real terms in America are up more than any other developed country that I really know of significance. And it's the home prices have tripled while this century, while incomes have only doubled. So you have a real sort of affordability issue out here. Why has this happened? And this is what the column tries to address, that we have people sort of offering all these solutions about rent controls, price controls. The real problem with the housing market is the fact that there's a massive supply shortage. By some measures, the number of new homes being created in America today is the same as it was in the 1950s. That's like such a big disconnect. The population has nearly doubled since then, but we're still creating the same number of homes. And after 2008 financial crisis, it's been even more acute.
How much of it was the 2008 financial crisis? Because it strikes me there's probably a hangover from that to some extent. It damaged the housing market so much, a lot of people really didn't want to invest in building houses.
Yeah, I think that there's a bit of that, but this even predates that. So the supply is where the real issue is, which, as I said, that if you look at the supply curve, we just haven't been building enough homes for a very long period of time for a whole bunch of reasons. A lot of this has to do with the government regulatory state, which is that it's very difficult to build here today, get the permits, deal with all the zoning laws, the coding laws. So the problem with America today is that the zoning laws we have go back to a vision of America back in the 1950s or so, where on large lots you had single-family homes, whereas that's changed today. But the laws haven't changed. And then, of course, you have some cultural issues, too. The whole issue of NIMBYism, which has become so popular.
Like not in my backyard.
Yeah, right? Not in my own backyard is the thing, that you don't want anybody else. So you say, it's an issue we need to address, but not in our own backyard. We don't want more homes out there. So I think that this is a very serious issue. And in fact, I know you mentioned just now that it's become a bigger issue in the campaign. I'm surprised it's not an even bigger issue. But still, in the debate this week between Kamala Harris and Trump, at least Kamala Harris led with that, which was impressive. But the real irony here is that Trump is the builder. And given the fact that he's a builder, I thought he would make a much bigger issue with this or do something about it, because he both campaigns on being the deregulator, as the king of deregulation, and he should understand the housing market. So I'm just a bit mystified why it's not an even bigger issue with the Trump campaign.
So focus in on the regulation, because presumably these regulations, including particularly zoning, are not evenly distributed across the country. Does that mean that the unaffordability is not evenly distributed across the country?
Yeah, so I'd say that the big cities in America in particular have much more zoning, coding laws, and of course you have places like New York and San Francisco dealing with rent controls, which further distort the market. So these markets have been suffering from an affordability issue for a long period of time. But the dramatic change that's happened is that this decade, now pretty much all of America, many cities across America, not just the large ones, housing has become unaffordable. If you look at it from a very basic measure, that economists would say that if you spend more than 30% of your income on housing, that means that you're stretched. Now, practically everyone is being forced to spend more than 30% of their income on housing if they want to buy a new home, because it's just so difficult to afford a home given the massive escalation we have seen in prices. And also, of course, it doesn't help that interest rates are on the higher side. But I'd say the bigger issue is the massive price appreciation that's taken place in America because of a big shortage on the supply side over the last few decades.
Which has led to inflation. We're all focused on inflation and therefore real wages or real income. What's the relationship between the growth in real income over time and the cost of housing?
As I said, that if you look at it, that over the last few decades, this century, in fact, the cost of housing has been increasing at a far greater rate than either inflation or real wages. So therefore, it's made the affordability become very difficult in this country. So I think that this is a broader statement here, David, about the regulatory state that we have in America, which is that we have created so many new regulations in our as that old line goes, that the road to hell is paved with good intentions. So the government thinks it's doing the right thing, but in terms of it's trying to create more and more protection, it thinks. But in doing so, it's created this regulatory state which is stifling business. So the other related topic here, which also I've written about in the past, is that small and mid-size businesses, their confidence today is very low. It's almost back to where it was near the 2008 global financial crisis, whereas the large conglomerates and the large businesses which can deal with the regulatory state in a more efficient way, their confidence is far higher. So we're seeing this across the state, and the housing market is obviously where it impacts the average consumer the most.
The level of regulation is very much in the presidential campaign right now, but when you're talking about housing, you have to talk about which government, not just government, but which government, because an awful lot of those regulations you're talking about are not federal regulations. There's not a federal zoning law. So is it really within the power of the federal government to preempt national zoning?
Well, they can do stuff to create a better incentive system, right? I mean, you make it a campaign issue. I agree that this is still a very federal country, and this is a broader topic about even the campaign, that we focus so much on the policies of what they are saying without sort of focusing on how much can really get done, whether it's the Congress or, as you say, it's the local governments and the state governments. But there are incentive systems that the central government can create to improve the housing market. As that old line goes, the first step to a cure is to diagnose the problem. So the issue is that this is now finally becoming a center stage issue in the campaign. There was very little discussion of this, in fact, until Kamala Harris picked it up a few weeks ago. Until then, I was shocked that there's no discussion about this, whereas that this is the single biggest grievance of most people. You have a dinner table conversation. It should be so obvious to anyone with a political antenna that this is the single biggest issue.
And as you say, we haven't heard much, I don't believe, from Donald Trump, former President Trump, about what he would do about this problem. When Kamala Harris, the vice president, came up with a proposal, a lot of economists were critical, saying what you're addressing is a lot of the demand side, not the supply side. You're going to give people tax breaks. You're going to be able to jack up the prices of housing, but it doesn't create more housing.
Yeah, so I think that she's done both. Yes, in terms of offering subsidies is like distortion, but she's walked back from some of the Biden proposals of rent control and all. I think she's quietly backed away from that, and she did focus a bit more on the supply side when she's speaking about that. And Trump too has responded to it. When he made his speech last week at the Economic Club of New York, he did talk about housing. But I just wish that it was an even bigger focus, given the fact that he is naturally a builder and his campaign should be build, build, build.
Maybe your column will get that done. We'll see. Ruchir, thank you so much. It's always great having Ruchir Sharma with us from Rockefeller International. Coming up, China is struggling to attract foreign investment. We talk with Deborah Lehr of Basilinna about why. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. China continues to fight an uphill battle to attract foreign investment, with the European Union Chamber of Commerce in China this week issuing a paper that says that the risks are really starting to outweigh the rewards of investment in China. For an update on the state of the Chinese economy and where it is headed, we welcome back now Deborah Lehr. She's head of the Basilinna. Thanks so much, Deborah, for being back with us. So give us your take. You know China so well. What is going on?
Great. Delighted to be back, David. So good to see you. And yes, it was only in 2021 that China actually was #1 in the world when it came to direct foreign investment. And now we are seeing a decline. And this is around a number of factors, foremost being confidence in Xi Jinping and his administration's economic and financial policies. There's tremendous concern about the ongoing drags on the economy around the reduction in consumption, the inability to stimulate growth through further government investment given local debt levels, the inability to stimulate the economy through massive exports given that many countries now are watching very carefully what China is doing with its oversupply, and the real estate market continues to be a drag on the economy. And that's putting aside, of course, all the geopolitical issues that they're facing now, as well as the issues around this move that Xi Jinping has really engaged on preferring national security to economic policy.
Yeah, and particularly making a drive here against some of the people who have been most successful and wealthiest, which has interjected, I think, a degree of uncertainty for those people who want to really be the Jack Ma's of this world. It's not such a happy place to be necessarily.
That's very true. I mean, you can see it from the statistics that actually have just come out about venture capital, where just in 2018, there were over 50,000 startups in China, and last year it was a little over 1,000. And they expect that number to even drop this year. There's a concern about investing and the access to capital, but also it's just the overall drag on the economy and these concerns about the continued insertion of party values into innovation in the private sector.
Is there any indication that President Xi might back off of that? That's really been very central in recent years to his policy. Is there any chance he might actually tack a little bit away from that direction?
Well, that's really the billion-dollar question, isn't it, in terms of where we see China's economic future. We have not seen Xi backing away from this emphasis on national security. There are all kinds of examples that we can cite related to that. What we have seen is they've been on a real charm campaign with international business. They've been sending delegations over here. They've been meeting with a number of Western companies to encourage them to continue to grow. They've been engaging in some market opening and reform to welcome the foreign firms and make it easier for them to do business. But the overall atmosphere continues to be one of concern. First, of course, because of where the economy is going, but to these concerns that American companies and European companies have about the focus on national security.
There's a host of factors, it appears, going into this, but how important are the trade issues, both with the European Union and the United States? Because there are real issues here. And by the way, going back to what you were talking about, national security, to a large degree, the Biden administration has made it sort of a national security issue.
Absolutely. I mean, we saw this begin under President Trump and definitely be continued with President Biden, and whoever wins in November, I'm sure will continue this trend where trade is no longer looked at as a way of opening markets and promoting reform, but in many ways it's a tool to influence policy. And so we see it as a negative tool to influence policy. And as China continues to grow and try and grow in areas where the United States or the Europeans might have concern, whether it's in climate technologies or if it's in artificial intelligence, we in the West have been much more sophisticated in how we've used our trade tools to close our markets and attempt to slow China's growth in those areas. So I see this definitely as an ongoing issue. And it not only affects it substantively, but obviously it affects the whole atmosphere for companies willing to do business in China. There are many, many sectors and many, many opportunities still. You'll hear the Secretary of Commerce talk about the fact that the overwhelming majority of our trade with China is benign. And we should continue to still engage with China. But the willingness of many of these companies who hear what's happening in the market, are concerned about the future of the overall relationship and what it means for them to be able to do business in China, has become, a real weight on their willingness to start to export or invest in China.
Here in the United States, right now, we're all fastened on the presidential election. And as part of that coverage, we spent a lot of time talking about the team around Vice President Harris, if she were elected, or the team around Donald Trump. What's the team around President Xi when it comes to economic policy?
That is actually a really good question. President Xi has brought many of his longtime loyal allies with him into the most senior positions. And many of them come from great expertise and provincial background, but are not as strong as previous administrations have been on international experience. If we even look at in the financial sector, the two people who lead the financial sector and the financial regulatory body, the Premier Li Qiang and the Vice Premier He Feng, have no financial experience, certainly not internationally. And the top regulator, the head of the People's Bank, is actually not even on the financial regulatory body. And we've seen sort of a systematic sweep against moving out many of those experts in the financial sector who were educated in the West, who actually have been part of China's integration into the international financial community being moved out, and provincial financial leaders being moved up and into office. Maybe that's a reflection of where China sees its concern. Obviously, with all this local debt, it continues to be a big concern for the government and a drag on the economy. But it is a bigger concern as we look internationally in China's continuing important role in the international financial community.
And that's in the public sector. There were reports in Bloomberg this week that there have been actions taken by the government against some leading investment bankers, actually, over in China, where they're being detained or their passports being taken or whatever. What is the chilling effect here on the professional bankers, as it were, in China?
You know, China is engaged in several anti-corruption campaigns and several waves of anti-corruption campaigns, both in the financial sector and others. And it has been of concern. We see it in the financial sector in current terms of even for Western companies, executives who are willing to relocate to China. You're not getting necessarily the best and brightest. In the past, it was often a path to promotion. Now it's being viewed as China for China, and China is an island that's unto itself in the financial infrastructure of many of these investment banks. It's been a chilling effect on the venture capital. I already cited some of the statistics, but we see many of these VCs moving offshore or looking for investment overseas. So it does have a significant effect, and particularly if they're going to arrest or detain local entrepreneurs, it just further adds to that concern of the willingness to go into the private sector and start your own companies. And that has a real effect on the overall economy, because if SMEs account for 60% of economic growth, 80% of urban employment, and about 70% of technological innovation, it's going to be very hard for President Xi to turn the economy around if we don't see those SME numbers growing.
And finally, Deborah, trying to see it from President Xi's point of view, is it possible he's saying, well, listen, you in the United States and Europe think it's all about you. It's not. There are other places in the world. I can do business in Southeast Asia. I can do business in Latin America. I can do business in the Middle East. And maybe that's where his emphasis is on, and maybe he doesn't need the United States and Europe quite as much?
Well, certainly we've seen a pivot away from the U.S. and European markets. Ours are still the biggest markets, and it will be hard to replace that with growth in the Middle East and Latin America and Africa. But we've definitely seen increased interaction. In fact, the premier of China is in Saudi Arabia as we speak. And we've seen an influx of Chinese companies into those regions. So they definitely will need to build that out. Obviously, there are other underlying reasons and even justifiable reasons at some level why China has been engaged in some of these anti-corruption campaigns, breaking up big tech monopolies and other things like that. It's sometimes that they go a little too far, and it has a spillover effect on confidence.
Okay, Deborah, it's always such a pleasure having you with us. Thank you so much. That's Deborah Lehr of the Basilinna Group. Coming up, telling the stories of capitalism from around the world. It's the next chapter for Wall Street Week. That's next. Finally, one more thought, and this one is about Wall Street Week itself. It's a program that goes back over 50 years to the days of Louis Ruchir on PBS.
Good evening, I'm Louis Ruchir. This is Wall Street Week. Welcome back. This was the week when the stock market staged what it euphemistically calls a correction.
The country's trade balance, which had been delivering its own brand of bad news for many a month, somersaulted in February and recorded the biggest one-month surplus in American history.
As of next week, we enter a new generation. We'll get out of the studio and travel around the world to bring you stories of capitalism, from Chinese-funded industrial parks in Mexico to the halls of academia in the United States and the United Kingdom, starting with Gillian Tett in her new role as head of King's College, Cambridge.
Public money is drying up.
The story of higher education, challenged on both sides of the Atlantic by a business model that can get in the way of teaching the workforce of the future.
Teaching kids is not just a business in the sense of having a profit and loss balance sheet. It's above all else, it's a mission.
The hardest business to change is one that's succeeded for a long time.
Welcome to the new Wall Street Week, telling the investors stories from business, markets, economics, tech, and climate, like how a derelict building became a symbol for restoring pride.
The train station felt like the right kind of challenger project for Ford to be part of, so that we could be part of the, revitalization of Detroit, and this felt like the kind of project that would be emblematic of our recovery as a company.
We'll bring you the story of how one lender used prudent investing, along with its position in between the mega banks and the community banks, to help build a local, family-owned company into $1 billion world-class business. How long have you been banking with PNC?
Since the beginning. Our first meeting with PNC occurred in my parents' basement when we were just starting our company, and it was over a couple of fold-out tables, and the relationship started there, and it's done nothing but grow immensely over the years.
Food is inclusive. Food doesn't really discriminate.
Melba Wilson helps us tell the story of the New York restaurant business. It takes good food, good people, good economics, and like any recipe, it only works when it all comes together.
Using food as a conduit to bring people together, but also to show people that come from the Harlems of the world that we can invest in our community and we can be the change that we want to see.
And what could be the story of the century, artificial intelligence. Wall Street Week takes you behind the scenes of a data center in Texas to tell the tale of an insatiable demand and how it can be met.
When you see the world's leading technology companies, who are as close to this as anybody, making the scale of investments that they are, to me that's an extraordinary sign of the potential that they see in the future.
Our pets are a story in themselves, but the companionship we crave from them turns into the story of a healthcare industry amounting to tens of billions of dollars a year and innovating fast.
What if there was a 20% reduction in your take-home income? Would you change what you spend for your pet when it's sick? And they wouldn't change it a dime. It's a member of your family.
In coming episodes of the new Wall Street Week, we'll go to Silicon Savannah in Nairobi, where the United States and China are waging a war over the future of AI. And to Mexico, where nearshoring is supposed to be cooling the appetite for Chinese goods. We'll tell the story of San Francisco and what its struggle with crime means for business. We'll check in on a World Bank development project to see what effect those extra special drawing rights have had. And go behind the scenes of the art world, the passion asset for many on global Wall Street. All that and more on the next generation of Wall Street Week. More than what you need to know, it's what you need to think about.